The main highlight of last week was the collapse of Silicon Valley Bank, one of the largest commercial banks in the United States. I'm Victor Cianni, Alpian's Chief Investment Officer, and in this episode, we explain in simple terms what happened and why it matters. In short, the bank became insolvent. To understand why, let's review first what the business model of a bank is, at least a simplified version. In essence, a bank aims to attract deposits from a diversified base of clients and put that capital at work either by investing it or lending it. If it is able to earn more money on the investment it makes and the loan it extends than what it costs to attract and remunerate deposits, the bank makes a profit. Operating a bank is about finding that subtle equilibrium between the investment and loan on one side, what we call the assets, and the deposits on the other side, what we call the liabilities. Because assets are supposed to match liabilities. The reason is simple. If a client decides to withdraw money from a deposit account, the bank needs to make sure that the funds are available. Yet, when the bank invests or lends the money, it is for a set period of time. So discrepancy arises when the duration of assets is different from the one of liabilities. In practice, this matching exercise is done by the Treasury Department of the bank, but the main idea is that this exercise is complex. Several issues can occur if the process is not handled correctly. First, the investments and the loan could perform poorly. If the bank lends the money to the wrong person or invests it in the wrong place, this would result in losses, and the bank may find itself unable to reimburse clients. Second, if all the depositors take out their money at the same time, the bank might struggle to generate the necessary liquidity. And that's basically what happened to Silicon Valley Bank, a combination of poor investment performance and depositors withdrawing their funds at the same time. There are several reasons why investors got nervous. First, there was uncertainty about whether the client could get their cash back or not. Usually, a portion of the deposit are insured by the government, but not the entirety. Fortunately, the authorities were prompt to step in and extend the guarantee to restore the confidence. Second, when a big bank collapses, there are fears that it may trigger a domino effect. After all, banks and companies are interconnected through the financial system. Finally, in an already challenging economic environment, this is an additional piece of bad news. We hope this video helps you understand what happened and why markets reacted so strongly. Stay tuned for more episodes.